Hello, everyone. My name is Brian Riley. I'm the Vice President of Centric Benefits Consulting. My contact information is up on the screen here. I am addressing you to talk about the May 1st G&C medical renewal. We chose this median because everyone's got a different schedule. We thought at least we could get the information out in front of you. If you have any questions about the renewal or what we're going to discuss today, please reach out to me. I can help with all benefit questions and questions about the new product, which we are introducing to you today. If you have questions about the rates, about your costs for the employee benefits plan, the medical insurance offered by G&C, then please ask Linda Landon those questions. The reason being is that not all of you have the same cost. Healthcare reform took away from us the easy, straightforward four-tier rate structure. If you're a single employee, you pay this much. If you are an employee with spouse, you pay that much. Healthcare reform took that away and left with us age-banded rates and headcount rates. So now it matters that the age of the employee. It matters whether or not they're married. It matters how old their spouse is. And then when it comes to children, it matters how old the children are and how many children are there. All of those factors are now plugged into our rate. So unfortunately, I can't give you a simple, straightforward, if you're an employee, doesn't matter if you're 26 or 62, here's your rate. Can't do that anymore. So don't kill the messenger. But it is what we're dealing with. So if you have questions about what your costs will be come May 1st, please ask Linda Landon that. For my part, when it comes to the benefits, please contact me if you have any questions regarding the medical insurance or any concerns. So let's begin. You have my contact information up on the screen. You also have this via email, I'm sure. These are the three plan designs that are offered by G&C FabCon. Now, you're familiar with the first two. These first two here, the silver and the gold, you refer to them as your base plan and premium plan, I believe. These plans are renewing. There aren't any changes. We're renewing these two plans. So if you like the plan that you're on and you want to keep it, then you need do nothing. If you want to move between these two plans, you can do that as well, or you can explore the health savings account option, which we're going to talk about. But just as a quick refresher, these two plans that you have both have deductibles in network. These deductibles, however, do not apply to everything. As you know, they apply to largely hospital charges, but not doctor office visit charges or prescription charges. So let's begin at the top. We'll begin with your silver plan, your base plan. This plan has a $2,500 single deductible, $5,000 deductible for an employee with one or more dependents. The coinsurance, after the deductible has been satisfied, is 50%. You would pay 50%. The insurance company would pay 50% until you hit your out-of-pocket maximum. Once you hit your out-of-pocket maximum, the insurance company pays for everything in network. So what is the out-of-pocket maximum? It's exactly what it sounds like. The out-of-pocket maximum is the max that you will have to reach into your pocket, pull money out, and pay for your medical or prescription care. Everything is applied towards your out-of-pocket maximum. Your deductible, your co-pays, whether they're doctor office visit co-pays or prescription co-pays, doesn't matter. Everything is applied towards your out-of-pocket maximum. This provision, this ceiling, this safety net, it's been in New Jersey for as long as I've been in the business, and I'm approaching 19 years doing what I do. We've always had this protection, this out-of-pocket maximum. But back when healthcare reform was being debated, and then President Obama was out talking about people going bankrupt, people losing houses and what have you because of the cost of healthcare, he never was talking about someone in New Jersey because we had this protection. healthcare reform made it mandatory across the entire country. So a lot of states that didn't have it now have it. But we've always had this ceiling, this protection. To remind you what it is on the silver plan, again, $6,850 single, $13,700 employee with one or more dependents. If you simply go to the primary care physician, $40 copay. If you go to a specialist, $75 copay. You'll notice, obviously, the specialist copay is higher. The insurance carrier is really trying to motivate you to go to your primary care physician, which sometimes you may want to. If you need to see a specialist, of course, go directly to the specialist. But if you, for example, have an ear infection, you could go to your primary care physician or your specialist. You're going to get a 10-day antibiotic to clear up that ear infection. Doesn't matter which doctor you go to, primary or specialist. In that event, you might as well go to a primary care physician and save yourself $35. Diagnostic lab, $20 copay. Diagnostic x-ray, 50% after deductible. So this is the first area where the deductible comes into play on this plan. Inpatient and outpatient hospital, deductible, and then 50% coinsurance. The difference, in inpatient hospital service, you get admitted into the hospital overnight. Outpatient service, you go, you have the procedure, and then you go home same day. That's an outpatient surgery. Now you do have, sorry for the abbreviations, but I got to fit a lot onto these pages. You do have a freestanding facility cost as well. So you could have that outpatient surgery at the hospital, you would pay 50% after the deductible. If you go to a freestanding surgery center, then you would pay 30% after the deductible. So you can save yourself some money there. If you find yourself in this situation, talk to your provider about where they can provide the service. Emergency room, $100 copay, and on top of that, 50% after the deductible. So know that you go to the emergency room, you'll have a $100 copay. That emergency room visit will be subject to the deductible, and if you do satisfy your deductible, then you will pay 50% of the cost up to your out-of-pocket maximum. If you're simply going to the pharmacy to pick up a prescription, you have a 3-tier prescription plan. $25 for generic drugs, if it actually costs that much. I'll elaborate on that point in a moment. $50 for brand name formulary drugs, and $75 for non-formulary drugs. So what does that all mean? $25 generic drug, I think we all know what a generic is, whether it's a prescription or if you're at the supermarket, we all know what the generic store brands are. Generic drugs aren't always $25 though. Last time I went to the pharmacy, I had a prescription that was $4.62. That was it. That's what I paid, because that was exactly how much the prescription actually cost. So they can't charge me $25 copay for a prescription that's full cost is $4.62. So $25 is more so a protection that you won't pay more than $25 for a generic drug. Formulary drug versus non-formulary drug. So there are multiple drug manufacturers. They all have contracts with the insurance companies. So pretend for a moment that there are 4 drugs out on the market that all treat the same thing, allergies. We'll use allergies. The insurance company is going to put on their preferred formulary list the 2 allergy drugs that give them the biggest discount. Since they got a better discount, they can pass some of that savings on to you. So if you use that particular brand name formulary preferred drug that's on the carrier's list, then you would pay a $50 copay. If you want one of the 2 drugs that are not on the formulary list, that's fine. That's your prerogative. You can do that. But you would pay a $75 copay instead of $50. The next plan that you have in place, I believe it's referred to as your premium plan. Very similar. Both of these plans that you have in place right now, neither of them have out-of-network benefits. Truthfully, I'm not a big fan of out-of-network benefits. The doctors that are in network, that are participating with the network, they have to agree on the discounted price that the carrier pays them. Outside of the network, they have no such agreement. And I see a lot of people who call me up and they have big medical bills for a doctor office where the doctor charged $4,000 for their time. The insurance company paid them $1,200, or the insurance company is saying that $1,200 is a reasonable fee. And that out-of-network doctor doesn't have to accept it. They balance bill the individual the difference. So to avoid that, I'd rather have a good network instead of out-of-network benefits. And that's what we have here with United Healthcare. Both of these plans have good networks, and they're also on the national network too. So if you happen to be traveling or what have you, you'd be able to plug into their national network. But this next plan has a lower deductible, $600 for a single, $1,200 for an employee with one or more dependents. The coinsurance level is 0% for some of the services there. You'll see following. The out-of-pocket maximum is lower, $4,500 for a single, $9,000 for an employee with one or more dependents. The doctor office visits, $50. There's no incentive here between primary and specialist. It's $50 copay whether you go to a primary or a specialist. Diagnostic lab, no charge. Diagnostic x-ray, no charge. Inpatient, outpatient hospital service. Now, instead of having a coinsurance for this inpatient, you have a flat copay. $500 copay per day, maximum of 5 copays per admission. So heaven forbid you're admitted into the hospital for 11 days. You would be asked to pay that copay for the first 5. The latter 6 days, you would not have any copay to make. The insurance company will handle it. But you would pay the copay for the first 5 days. So it's a maximum of 5 copays per admission. Outpatient hospital surgery, again, you go to the hospital, you have the procedure, you go home. At a hospital, 50% coinsurance. So you would pay 50% of it, the insurance company would pay 50% of it. Freestanding, simply a $50 copay. So again, if you find yourself in that situation where you need an outpatient surgery, talk to your provider and see where they could perform it that would give you the best discount. Hospital emergency room, $100 copay. Go to the emergency room, you pay the copay. Prescription drugs, again, 3-tier, as we discussed before, $25, $50, $75. Now, as you can see, it's a more generous plan. As you would expect, it's a more expensive plan than the first plan that we spoke about. I say it's more expensive, I say it's more generous. I don't say that one's better than the other, because there is no best plan. There is the best plan for the particular person. Which brings me to the plan that we're going to introduce, the health savings account. Now, for starters, I'm on an H.S.A. with my wife and my 2 daughters. I've been on an H.S.A. since 2007. The thought process with the H.S.A. was what was best for me, and perhaps some of you will like this idea as well. Back in 2007, I approached my employer and I said, look, I don't want to put money into the insurance company's coffers when I'm really not using the benefits. I'd rather choose a path that will allow me the opportunity to put some money into my own coffers. That's where the health savings account came in. With the health savings account, we have a high deductible, but unlike your other 2 plans, this deductible applies to everything. Doctor office visits, lab, x-ray, hospital, prescription. The deductible applies to everything when you sign up for a health savings account. Everything minus your annual checkup. That is still 100% covered. So why would someone do this? Well, they would do this for the same reason that they would raise the deductible on their auto insurance. All of you have auto insurance. You increase the deductible. What happens to your premiums? They go down. What do you do with that premium savings? plug them into an HSA, a health savings account, bank account, and instead of saving those premium dollars in the insurance company's coffers, now save those premium dollars in your own coffers. Put that savings into your own account that you own. You can put the money in the account on a pre-tax basis, which means that you're not getting taxed. Uncle Sam is not touching that money. If you put $100 in because you didn't get taxed on it, it will only feel like $75 out of your cash flow. Whatever money's in the account at the end of the year, whatever money you don't use, rolls into the next year, so on and so forth, with no limit on how much you can roll over. I stress that because some of you might be hearing me talk about this plan design and thinking to yourselves, well, wait a second, isn't this a flexible spending account? Similar, certainly not the same. With a flexible spending account, you have money taken out of your paycheck on a pre-tax basis, so you take advantage of all those tax savings. But you have the dreaded use it or lose it feature. If you don't use all the money, then you simply lose it. With a health savings account, there's no such feature. So whatever money you don't use, you simply have in year 2 or year 3 moving forward. I was on this plan when I was single, and I was able to save up a decent amount of coin in this account. I used the insurance, don't get me wrong. When I needed to use the insurance, I used it. I had one trip to the emergency room while I was single. Had to use that money, and luckily it was in the account. But I was still able to save money into the account year in, year out. When I got married and my wife and I welcomed our first child, she, on her employer's plan design, had a high deductible plan, similar to your base plan. So the hospital, the delivery was going to go towards her deductible. We didn't have to figure out where that money was going to come from because luckily we had saved it, or I had saved it, in my HSA account. So her deductible, I had more than enough to cover her deductible saved up in my own HSA account. It's not a new tool. It might be new to you, but it's not a new tool. They've been around since 2005, and again, I joined them in 2007. That's when I opened my HSA account. And the idea here, again, is to bring down your premium, put those funds in that account that you own, and then save the money year in, year out for future expenses or for years that you simply need it. So that is the idea with this health savings account option. We'll talk about it a little bit more, and you can get the cost for it from Linda. But again, with the HSA, everything goes towards that deductible. Let's talk about the money that you can put into the account. One second, please. All right, so the IRS looks at how much money that you can save into an HSA as a very generous offering. All right, and we all know they like to collect tax dollars. So the only way that you can sign up for the bank account is if you are enrolled in a health savings account eligible plan design, which G&C will now be offering. You have a contribution limit. It goes up a little bit each year, cost of living adjustments and what have you. In 2018, the most that you can put into your HSA account is $3,450 if you're single. If you're an employee with one or more dependents, they say simply family, but you could be husband, wife, or parent, child. An employee with one or more dependents, you can put in $6,850 into your HSA account. If you're age 55 or older, you can put an additional $1,000 into it. Now, you may ask, well, why would I put more money into it? You could simply be a saver, or you could be embracing this product like I did. I said earlier that these are similar to flexible spending accounts. They are in two big ways. One, you can put the money in on a pre-tax basis. Two, whatever you can use your FSA, your flexible spending account dollars for, you can also use your health savings account dollars for. So imagine, if you would, you're in my shoes. You're putting money in and you want money to be in there to cover your deductible. But then the dentist tells you that your daughter is going to need braces. So you could pay for those braces with after-tax dollars. And any of you familiar with it, you know that that's expensive work. Having an HSA allows me to save up money in that account and use that money for such things as dental work, as vision. Perhaps you don't have vision insurance, or even with dental insurance or vision insurance, you still have expenses out of your pocket. Wouldn't it be great that you could kind of bank on yourself here and participate with a vehicle that will allow you to save money on a pre-tax basis? That's huge. If braces are going to cost $4,000, which I know I can almost hear some of you scoffing that they're going to cost more than that, but let's just use $4,000 as an example. If braces are going to cost $4,000 and you're allowed to use pre-tax money, then you're not being taxed on about 25% of that expense. So the dentist is going to get his or her $4,000. They got their money and they really don't care where it came from. But since you used an HSA bank account that you made deposits to, and you used those funds to pay for your dental, you never paid taxes on that money. So that's going to feel more to the tune of $3,000 expense for you as far as your cash flow goes, because you use this tax-saving vehicle. That is the beauty of an HSA. That's why they're growing in popularity. People are taking more control over their own finances and not simply paying the increase that the insurance company wants each year for the premium. So these are the amounts. You don't have to write any of these down, but by the way, you actually probably have all these with the email that you received with the link for this pre-recorded webinar. So you'll access it there. Also in the email, you're going to see a quick piece that I put together, just a Q&A. What is a health savings account? I'm not going to read this to you verbatim, but it's going to echo a lot of what we talked about here today. You open up an HSA, you benefit from lower premium for your insurance because you have the higher deductible plan, which applies to more things. You use some of those premium savings, and then additional money if you can squirrel additional funds into the account. You fund the HSA. Whatever you don't use rolls into the next year, and the money that's in the account you can use for any IRS eligible expense, whether it's your medical expenses, prescription expenses underneath your Oxford United Healthcare plan, or if it's a vision expense, dental expense, acupuncture, if you want to give it a shot. One thing that I always like to point out to everyone, especially since many of us are in the sandwich generation, long-term care. The money that you save in your health savings account, you can use not only for long-term care itself at a facility, but you can also use those funds for long-term care insurance. So if you decide to purchase a long-term care policy, an insurance policy, you can use whatever funds you've saved away in your health savings account to pay for the premiums on that plan. That's a terrific benefit as well. So there's a lot of things you can do with this account. It allows you to take control over your expenses, which is a fantastic thing in my eyes. So that's all I'm going to talk about for today. Again, I really wanted to introduce you to this concept. Please give me a call. Let me know if you have any questions. More than happy to talk to you about HSAs in your particular situation. The rates for the insurance, again, you'll get those directly from Linda. And I hope that this was helpful. I tried to be brief and I tried to cover everything all at the same time. So I hope I balanced that well enough. Thank you very much for your attention and have a great day.